The US dollar manages to find a little bit of support as stocks unclench and the bond market again finds a familiar bottom. Are we perhaps starting to flirt with the possibility that the worst is over after a rough start to this week? Or is this the temporary bit? Is this the reprieve? And are we going into something more scary and uncomfortable as the week progresses? That's what we are going to unpack here as we break down these markets on macro money. I'm Ilya Spivak, head of global macro here at tastylive, and today we are going to put a lens on this conversation that is going to approach what's happening from the perspective of the US dollar and sort of the window that it offers on what the situation is, how it is developing, and what is likely to come from here. Because, of course, there is a diversity of markets here showing various things, but what we certainly find here is that there is a situation where the most liquid of all markets and the sort of cash of choice for global investors is shaping up, if only as an indicator, to be one of the more glaring sort of signals suggesting that what we might have been used to before is not what these markets are currently showing us, and that whatever may be a near-term resolution or a near-term recovery might not be appropriately treated were we to wear the same hat that we might have worn as investors over the past 40, 50 years. That in fact, what we are entering is a period that is fundamentally different from not necessarily all history, of course. Economic history is tremendously varied and diverse, but a period different from the post-war normal that has persisted basically since the untethering of the US dollar from the gold standard in the early 1970s by the Nixon administration. So let's take a look here and unpack what currency markets seem to be saying here and how that might then extrapolate elsewhere. So first things first, this is the dollar index, and what this is albeit an imperfect, but the standard basket measuring the dollar's performance against its major counterparts. I say imperfect because this basket was created before there was a euro. And so this was a diversified basket at one point because it included currencies like the Swiss franc in addition to a French franc. It included a German Deutschmark, an Italian lira. And obviously, while the Swiss franc is still its own currency, its significance has diminished in global trade by leaps and bounds, and many of the others have fused together into the euro. And so the basket is a bit skewed to an older reality than what persists now. Tellingly, this basket doesn't include, for example, the Australian dollar, which is now the fourth most traded global currency because of its reflection of the rise of China, and China's own currency being something that's tied up on shore with various capital controls and competing exchange rates and what have you. So it's not a great basket, but it does tell a story. And the story here clearly is one of dramatic US dollar weakness since the beginning of the year. Now, it's important to put this dollar weakness in context because it is happening under very unusual circumstances for what the financial architecture might have been expected to produce. So here's the beginning of the year. We can see the dollar is selling off. Now, this is happening at the same time that stock markets are selling off. Here is the decline, obviously, in the S&P 500 as a kind of benchmark for what's going on. That starts to be something that is activated, let's call it early to mid-February or so. That's where we sort of establish the beginning of the move, but you'll notice the highs actually are set all the way back in early December as we start to get ready for the transition into the into the calendar turn, and of course the administration in Washington D.C. Turn from 2024 into 2025, and we set the high in December. We ultimately never set another one, but the sell-off starts a little bit later. We likewise, this is sort of something that's been occurring more recently, going to the beginning of April, are seeing a sharp decline in the bond market. Now, we can see that since the beginning of the year, this part of the equation was actually moving in the other direction and working as you might expect. So we start with there is a growth scare because economic data that starts coming out in late February begins to show that business and consumer confidence has been severely hampered by uncertainty around the rollout of the Trump administration's new fiscal policy. That's at least what consumers and businesses are telling in these surveys. And what you then see is they're holding back on economic activity as a consequence of that uncertainty. And because they're holding back on it, economic activity significantly slows. And so the markets say, oh, well, okay, so this means earnings down, right? Stocks begin to decline. And the Fed is probably going to have to cut rates to combat whatever economic malaise is coming. So bonds up. We, of course, know bonds move inversely, bond prices, that is, move inversely with bond yields. So you get bonds higher as you see expectations for stimulus build. And indeed, if we take a look at what is being priced into Fed funds futures, we can see that indeed, since the point where stocks begin to sell off, you get a more dovish shift in Fed policy expectations, both for this year and next year, but most importantly, for this year. You go from a cumulative of about 50 basis points in cuts over this year and next being priced in around the start of February, and the outlook for this year being a single rate cut of about 25 basis points being baked in. You've now gone to closer to 90 basis points. And so, of course, you see the response in bond markets as you might expect to see it. So far, so good. Everything here seems to follow familiar norms. But then the bond market marks a strange turn. At the beginning of April, there is this violent sell-off where bonds crash, yields surge. And against that backdrop, stocks keep selling off. Here's April and that push through support at just above 5,500 on the S&P that follows with that bond sell-off. And again, most interestingly, the dollar sells off also at the same time. So whereas this, you might surmise, makes perfect sense because, okay, stocks are selling off, the Fed is going to cut rates, weaker growth, lower yields. So the yield-based support for the dollar is eroding because if the Fed is going to cut aggressively, that'll undermine the dollar's yield advantage against other currencies. Very, very classic. Dollar sells off. Here, this looks a bit odd. Not only in its violence, but also in its direction. Because this is happening as yields rise and stocks sell off. Now, we've talked about this extensively before, and we'll come back to it here because it is a useful view on what we are seeing here. This is the dollar smile model developed by economists Stephen Jen. And what we see here is the relationship of the dollar to global growth dynamics that really reflects how the dollar has worked since untethering from the gold standard occurs in the early 1970s, and really describes what the financial architecture, what the monetary architecture of the current financial system has been over that time. So we're looking at about 5 decades here. And so what we see on the bottom here is the relative outperformance or underperformance of the U.S. economy. So here's 0, where the U.S. economy is growing at about the same rate as its G7 major counterparts, so other big developed economies. In this direction, the U.S. is underperforming. In this direction, it is outperforming. So here the U.S. is growing faster. Here the U.S. is growing slower. And we relate this to the value of the dollar. We can see here that the dollar is relatively stronger, that is up relative to here, up relative to here, 0, when the U.S. is either doing much better or when the U.S. is doing much worse than its global economic peers, such as they are. Now, why is this? This is obviously special. This is obviously different from other major currencies. This is because the dollar is the quintessential unit of global commerce. We're going to get an updated set of these statistics from the Bank of International Settlements this year. They publish them every 3 years, and 2025 is one of those years where they're going to update it. But most recently, we see 88% of global monetary transactions are settled in the U.S. dollar. And that is because of its unrivaled liquidity. So when the U.S. is outperforming, it's the usual story. Oh, well, U.S. is growing faster, so the Fed is hiking rates more, so the dollar's yield advantage builds, dollar goes up. This is how all currencies work for the most part. If the economy is strong, inflation expectations go up, central bank raises rates, yields on the currency become more appealing, and people buy it. It goes up. That's textbook. What's exceptional about the dollar here is its unrivaled liquidity means that when there is some sort of turmoil, such as when the world's largest economy is going into a crisis or a recession, like this, where the U.S. is underperforming and dragging down everyone along because it is the world's largest economy and the deepest consumer market, capital flees to safety. People cash out of riskier assets, but what is their cash of choice? It is the dollar, or has been. And the reason it has been is because of this unrivaled liquidity. It's easy to come in and out. It's not something that's going to move a lot with huge capital inflows and outflows relative to other currencies. And of course, because of its built-in underpinnings as the indispensable unit of commercial exchange, there is the very strong basis of mutualized necessity. Global commerce needs a vehicle. Secondly, because it is underpinned by the faith and credit of the U.S. government, which is, for all its warts, the world's most eligible borrower because it is sitting on the absolutely biggest asset base in the known universe. It's got a lot of collateral to put up, and more collateral than pretty much any other borrower that we know of. So, not surprisingly, the dollar becomes the cash of choice in anti-risk or risk aversion times. If this was the regime before April of this year, it is obviously not the regime now, because neither higher yields, that is lower bonds, or risk aversion are doing anything to help the dollar here. It is unable to take heart from any of the traditional vectors of support. It is, in fact, going the other way. And the explanation seems to be a breakdown in the architecture itself, where what you see around fiscal policy uncertainty most critically is first, and perhaps foremost, a jump in term premium baked within U.S. Treasury yields. That is to say, the cost of compensating for duration risk, the cost of paying for U.S. fiscal uncertainty, has jumped to the highest since May of 2021, on the eve of the Fed's rate hike cycle, on the eve of the Fed admitting that it needs that rate hike cycle in the middle of 2021, which is a huge inflection point post-COVID for global markets. And so what you then find is that this growing risk is driving capital out of U.S. dollar-denominated assets writ large, be they the dollar or U.S. stocks or U.S. bonds. Everything is falling in tandem. Moreover, this uncertainty is translating into expectations of a steep recession that then brings inflation net down, despite the fact that ostensibly the catalyst for all of this is the increase in tariffs that the new Trump administration has announced that will lift prices on virtually everything, because it increases the prices of inputs as well as of imported finished goods, and thereby lifts overall price levels. That this is being reflected as falling inflation expectations, so-called break-even rates, baked into bonds, suggests that the markets are already seeing through the rise in costs and to the economic damage that it will cause, and the recession that will follow, and the loss of demand that will follow. And that what this will do is actually end up with net lower inflation, not higher, because of the economic damage. We can see that show up, of course, in the flow of economic data. We've used this Atlanta Fed GDP Now model as a kind of barometer for the direction of economic data, and we can see that the inputs into this model, which is updated anytime that a big piece of economic data comes out, hence the nowcast sort of nature of this, we can see the tone of the data has clearly been negative, because what it's done since February is push the model lower and lower and lower. Never mind whether we actually get a growth rate of between 2 and 3% on the downside when Q1 GDP numbers actually come out. That may or may not occur, and ultimately isn't what's important here. What's important is that the model is sloped the way it is, suggests the inputs that have been going into it have looked abysmal. And so, needless to say, of course, as we just saw, this has translated into the idea that the Fed is going to have to cut rates to battle an economic downturn, which, of course, is already in the markets to some extent. We can see this adjustment. Perhaps as more economic data comes in, more of an adjustment might be necessary. As it stands, the first rate cut seems to be on the menu for July, after which we start to see a more accelerated pace lower. And looking at the numbers we've started to see on what the economic growth picture around the world is looking like, maybe there's a reason to see this move into a still more dovish sort of setting. We just got numbers today from the IMF. They updated their world economic outlook, and we can see that, not surprisingly, the direction of travel is overwhelmingly lower. So for world GDP expectations for 2025 marked down versus the outlook in January, which was itself a markdown from the outlook in 2024's last update in October. So clearly, this is looking meaningfully weaker than sort of the recent expectations. That extends to the advanced economies, of course, to the United States, which actually sees the biggest downward revision in expectations for 2025, sort of amongst the majors, and also the biggest, or one of the biggest ones, the only bigger one it seems like is China for 2026. And we can just see the negative numbers here pretty much across the board for everyone except Spain, of all things. But Spain is not a big enough economy to right the ship if the U.S. and China and the Euro area more broadly is looking weaker. We are going to now get a set of PMI data over the next 24 hours that may well speak further in this direction. The expectation is weakening Australia, back to contraction territory here, weakening in the Eurozone, a softer flavor of standstill there, weakening in the UK, a return toward standstill there, and for the U.S., significantly weaker service sector performance and a return to contraction in manufacturing that almost certainly brings us closer to standstill on the composite after a bounce in the previous month's numbers. So all in, this seems to translate to still lower interest rates and still more of a pressure for more easing from the Fed to combat whatever economic downturn is being flagged right here, which, of course, again, is bad news for the US dollar. So, in that the dollar is unable to find its familiar support, and in the longer term conclusion that probably all of this resolves as the markets anticipate in a Fed that's more dovish, lower interest rates, and eventual rate cuts of size, probably means that this move here is perhaps far from over, and that we're looking at structural regime change. And if that's the case in currency markets, it may well be the case more broadly. Because if we are going into some sort of whole new architecture on the price of cash, the cash that powers the global system and almost certainly will continue to power it, well, then the reaction function elsewhere, almost by default, might be considered different, and the environment as a whole might start behaving in ways that we're not used to in recent decades for a much longer period of time. And of course, for traders, the upshot here is any pull-up in the US dollar near term, because of course markets don't move in straight lines, probably looks more like a sell than anything resembling a trend change. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. In 30 minutes' time, I'll be on with Victor Jones for The Price of Truth, as I am every Tuesday. Back with Chris for First Call on or for Futures Power Hour, rather, on Friday. Back with Victor for First Call and with Tom on Sundays. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Good.